And I think the next 10 years, 5 years at least, is going to be the epoch of high inflation and high interest rates.
Inflation effect of the war is more in Europe, most pronounced in Europe
Yeah.
than anywhere else in the world, I think. And it's been an earnings season where quality stocks have delivered. And my sense is that people sitting on good quality equities in their portfolio, they would take a lot of satisfaction.
Welcome to podcast number 4 now, I
Yeah.
guess, I think. It's been a long ride and I think we've got ourselves a nice rhythm. And,
Absolutely.
we've got a lot of interesting things to talk about today.
Look forward to it. These conversations with you are extremely enlightening and brings out a lot of thoughts at my end as well.
And hopefully it introduces new thoughts to the users as well.
That's the whole idea. We add value to their thought process and perhaps give them a few ideas as to how they should manage their portfolio and eventually their entire savings plan.
Yeah, absolutely. So I guess let's start with the first thing that we have to talk about today.
Mhm.
And I think a lot of interesting news from the macroeconomic side.
Yes, big announcements today, last week rather, right?
Yeah,
On the inflation front.
yeah.
So tell me about it, yeah.
So I think two notable pieces of information. Both were surprises. I think we had a surprise from the US Consumer Purchase Index, which is effectively measures the price of goods for consumers in the US.
US inflation, yeah.
Yeah, which came in at 6.4%
Wow.
versus
Wow.
an expectation of 6.2%. I mean, you go back, 3-4 years at 1%, 2% inflation, now it's 6.4%.
Who would have thought of this thing?
Yeah. And India as well. We had a surprise at 6.5%, where the street expected about 6%. So I think we have inflation surprises on both the US side as well as the India side.
That's not good news, is it?
No. But it's expected. I mean, this is we're effectively in a whole new epoch of the global economy. I think for the last 10 years. So if we go back to 2010, from 2010 to 2021, really, we were in the epoch of low inflation and low interest rates. And I think the next 10 years, 5 years at least, is going to be the epoch of high inflation and high interest rates. And that's the really interesting, I mean, it's a really, really interesting place for the global economy. Because if you just think about like the three big economic spheres of influence, right? You have the US, you have Europe, and you have
Asia Pac.
APAC, right? China, Japan, South Korea, Taiwan. Now, the US for the longest time was, enjoying low interest rates, low inflation.
And that's why they inflated the economy with QE2 and QE1 and all those.
Yeah. And that's what allowed them to sort of spend as much money as they did and print as much money as they did during the pandemic. But they've obviously overdone, right? They've obviously overdone it. And I think through mid-2021, you saw inflation picking up in the US quite substantially.
Mhm.
I think that's peaked. I believe it peaked around June 22, and it's been falling since. But
Then we have this number again, but yeah.
no, I mean it's this number is off the peak, right? But it's still relatively high. And if you look at the components of this inflation, it's really food inflation and energy inflation, right? Energy inflation emanating out of the Russia-Ukraine war. As well as food inflation emanating out of the Russia-Ukraine war. And that's going to stay very stubborn.
But even though the war gets over, you think it will stay?
So, I mean, there's two different components to inflation here, right? The first, the really big component, I mean, again, we'll go back to our three big spheres of economic influence. The first is the US. Now, in the US, inflation was picking up by, I guess, mid-2021. By April 21, inflation had started picking up. And that's because of too much money printing. That's the over expenditure during the
That's
pandemic.
not going to go away.
Yeah.
Whether the war is there or not, I think.
Exactly. They've inflated their balance sheet a lot, and that's going to take a long time before it normalizes. So that's where inflation in the US sphere of influence comes from. The European sphere of influence, okay, they inflated their balance sheets, but that's because they needed to keep interest rates stable across the entire Euro bloc. They can't have borrowing rates in Greece, 3 times that of what it is in Germany. So that's where they had to inflate their balance sheets. And then obviously the war struck.
I think the war effect is more, inflation effect of the war is more in Europe, most pronounced in Europe than
Yeah,
anywhere else in the world, I think.
yeah, yeah,
Their supply chains have all got completely
yeah.
messed up. Yeah.
But supply chains is and that's where the APAC phenomena comes in. The geopolitical tensions in China. Uh, that's all because of you know this supply chain disruption, and that's what's driving inflation over there. In particular as well, I think China's reopened their economy, and that's why you have a surge in consumer spending, which I think every economy experiences
Yeah,
post
that's true.
lockdown.
We did this as well.
Yeah. So I guess we're just in this high inflation, high interest rate
So,
epoch.
what does that mean for equities? I think that's a very important, I would say, phenomena.
I was thinking about this. I was thinking about this more in the context of Indian equities, right? So you have three really interesting phenomena taking place simultaneously. First, you have higher inflation, but not runaway inflation. India in particular, we're at 6.5%, and our inflation has generally stayed between the 4 to 6% range.
Yeah, that's true.
So it's not
And in a way,
crazy
we are
high.
used to dealing with high
Yeah.
inflation or mid to high
Yeah.
inflation as well. Yeah,
So we have relatively high inflation, across the board.
that's right.
We have a slowdown in growth globally. So I think the world is, everyone's saying it's going to enter a recession. We don't know if it's actually going to enter a recession. But India is not really facing a
Yeah,
recession.
but the export sector will definitely get impacted.
I am not. I would not.
China plus one.
Oh no. I don't think it's China plus one. I don't think it's a China plus one phenomenon at all. I think this is an interest rate and currency exchange rate phenomena. So if you go back to start of 2022, I think the rupee was at 73 to the dollar. We're now at 83, something like that to the dollar.
That's true.
So I think our exports are going to get protected by
Falling
the
rupee, yeah.
rupee's depreciation. So I would, but going back to my original point, we have this environment where you have reasonably high inflation, and reasonably high inflation always gives firms pricing power because they can raise their prices
That's
and
true.
justify that. There's reasonably high interest rates globally to fight that high inflation, so the cost of capital is going to stay high. And in India especially, I think we're expecting growth of 6.3 to 6.7% over the next couple of years, which is not the blowout numbers of 7-8%,
But still adequate.
adequate. So you have this scenario where there's some growth in the economy, there's pricing power at firms, and firms that are inefficient with their capital are going to be paying a very high price for that capital. So it's going to be a stock picker's paradise.
Wow.
If you can find the right scripts and you enter it at the right time, and if the companies you're invested in can consistently generate profit and deploy their capital efficiently, over the next 2 to 5 years, they're going to be blowout winners.
So I think that certainly supports my view that there's uneven growth. And whenever there's uneven growth, then obviously there are going to be a few winning sectors and specific companies within those winning sectors, and then others are going to struggle. And I think this time's earnings season is clearly a reflection of this uneven growth which we are seeing in the economy. And we'll come down to that, but I think it's a very interesting point you made that there's going to be a stock pickers market for the next, at least into the foreseeable future, for next 1 year or so. And that makes our lives very interesting, and hopefully we will give very, very many interesting stock ideas to our all our various followers.
Yeah. So why don't we dig into the earnings season? Right?
Absolutely,
It's
yeah.
been broadly speaking, I think it's been a pretty good earnings season for Indian corporates. Is that
Yeah,
fair
it's
to
been
say?
it's been a good earnings season, and it's been an earnings season where quality stocks have delivered. And my sense is that people sitting on good quality equities in their portfolio, they would take a lot of satisfaction with the way this earnings season has played out. And as we get granular about each company, each sector, we will tell you how clearly this has been a pretty decent earnings season and many new ideas coming out of it. Varun, I always look at an earnings season in terms of when I enter it, did I have more ideas than when I'm exiting it? And I feel excited that when I exit this earnings season, I have lot many more stock ideas, and I have many more companies which are delivering good growth than when I thought before.
Great. So why don't we dig into some of these ideas? I was thinking, we can go sector by sector.
Yes, absolutely. Let's go with the biggest one, banks.
Okay. So I think IDFC first stood out to me in terms of, really, really quality earnings.
Absolutely.
And HDFC Bank is a bellwether. But how did the sector do overall? And, any other underperformers or outperformers that you identified?
So these are absolute blue sky scenarios for the banking industry. Uday Kotak has said this is a Cinderella time for the banking sector. And I can't agree with him more because on one hand you have the credit growth coming through because economy is picking up, so there's more and more demand for lending credit products. And whenever you lend, obviously the fee-based income also goes up because that's when you tend to earn a fee around it. And the biggest cost for the bank, that's the NPAs. I think that's very well under control because they have provided for all the old NPAs and the new NPA cycle hasn't started. So we are seeing record profits across the board from all the banks and NBFCs. And doesn't matter what the background was, doesn't matter how you fared over the crunch time or the crisis time in the banking industry. But right now, I think almost every bank and NBFC is just raking in the mullah over there. And clearly, it's a challenge more in terms of raising resources to lend, keeping your balance sheet strong, rather than trying to find new borrowers and trying to maintain those net interest margins. So these are great times, and we of course said IDFC First Bank. I think on all parameters, especially I like the fact about their 43% deposit growth. There's a war for deposits over there from banks and BFCs.
Absolutely.
And the winners are going to be the ones which can
raise the most money.
Exactly.
And because
HDFC Bank also,
you have
yes.
the most deposit growth, you can lend the most money. Lend the
Exactly.
most money, you have the largest balance sheet.
Absolutely.
That's where your money is getting.
And these are great operating leverage businesses because their costs remain the same, and if they are able to lend more and earn higher interest income or other net interest income, a lot of it does flow to the bottom line. So very, very positive on banks. And I think
I have a question here though. Yes Bank seems to have done very badly.
Yeah, I think it's partly base effect, and some of the bank we thought will get into a rhythm, but not yet so. But there's a very important development in Yes Bank, and a large part of their NPA they are transferring to asset reconstruction company. So that will remove a big burden on the balance sheet. But it's a good bank. I wouldn't write it off and keep it under the watch. Maybe it will start to display better results. But what was I think most noticeable is that the PSU banks they continue to lose market share, but nonetheless their performance was exceptionally good, and the trading rally I think can get sustained post these numbers which we have seen. And then coming to the NBFCs, I think across the board NBFCs did very well. See, NBFCs they lend to the housing sector, they lend to the automobile sector, and they lend to retail for personal loans, credit card, appliances, so on and so forth. And across all their various credit products, they have seen very good demand for growth. And so far, I think they have adequate bank limits and other debt instruments because of which they've been able to grow their balance sheet. Two companies come to mind over there. Bajaj Finance came with very good set of numbers, and so did Cholamandalam. Some of the smaller ones, which had been, I would say, completely stressed out during the IL&FS crisis, the likes of M&M Finance, L&T Finance, Poonawalla Finance. I think they all also turned around and displayed very good numbers. But I'm not very hopeful. I'm not that enthused because I like to buy banks and NBFCs which have done well when the times are bad, when it is crunch time, and these companies certainly disappointed on that count. So thumbs up to the banking sector. Great set of numbers, good earnings visibility, and I would say that 35-40% of your portfolio has to be in the banks or in NBFCs.
Okay, so let's move on from the banking sector. Right, we know they're on a great wicket.
Absolutely.
Let's go to something that's maybe a little bit more difficult for the consumers to understand. Capital goods, mixed bag of results, I'd say. How would you interpret the results across the capital goods sector?
See, I think that capital goods also is a sector which did very well in this earnings season, expectedly so. We have been tracking their order book position across the board, across all segments of the capital goods industry, we have seen higher and higher order book. And that is manifested in excellent numbers coming through from these companies. Now, there are really basically the biggest engine for capital goods is the spending the government does on infra, state as well as center. And that clearly has been extremely strong. And going forward, also post budget numbers, we expect the capital spending in the economy to pick up. But more importantly, Varun, we are seeing after many years a pickup in private capex. So I'm not sure so much about large steel plants, but new cement plants coming up, new pharmaceutical plants coming up, automobile, auto ancillary, they are expanding at a decent space. All agro-related equipment industry, they are expanding capacity. Chemicals is a big, I would say, engine as when it comes to additional capacity. So that's driving a lot of demand for capital goods. And I think every single company within the capital goods space is sitting on a very big order book position. And within the capital goods, let's just go a bit more granular. So we have the infrastructure builders, the Larsen& Toubros, the NCC, ITD Cementation, Dilip Bilcon, IRB Infra. These are the ones which are setting up the roads and the ports and the airports and the metros within the country. They are sitting on massive order book position. And then there are these engineering electrical companies, ABB, Siemens, Honeywell, Triveni Engineering, many such companies, Elecon Engineering, which do actual Thermax, which actually, design and deliver the equipment which goes into plant and machinery. And they also, I think, have done exceedingly well. So I would say that it's been a great season for capital goods. Last season, they were impacted by higher raw material prices, but steel prices have flattened out and they've passed on some cost increases as well. And these are great times. I think I can when I'm looking at these companies, I see them pick and choose their orders. So there's no stress that we have to keep our factories going and take orders at any price. So what you will see in the next 2-3 quarters is higher operating profit margins and better return ratios for the capital goods industry. And these are two very important industries, banking and capital goods. If they do well, then they provide a trigger to the larger economic forces.
Yeah. No, I mean, it's interesting. I think I hadn't picked up that private capex is rebounding quite strongly.
Absolutely. I think every company we speak to, they are looking at expanding capacity, and they haven't expanded capacity for the past 7, 8, 10 years or so, and demand is catching up over there. So I think that new data centers being set up, new airports coming up, new chemical plants. There's so much happening in the economy now.
Any winners, any companies in particular in the capital goods space that you think are must buys or stocks to watch?
See, Varun, we covered Praj Industries. Again, the disclosure here that we and our clients are invested. So basically, India is going from 10% to 20% ethanol blending. That means we need to double our distillery capacity. And Praj Industry clearly, I think, is a company in the right place at the right time if you want to ride this particular investment theme. So that did exceptionally well. Of course, Siemens ABB also delivered excellent set of numbers, but they're very expensive. And I don't think that a lot of large institutional investors or retail investors are very much invested in the likes of Siemens, ABB, Honeywell. They're good, but they are just too expensive on a price to earnings multiple basis.
Okay. Let's run through this because we've got a long list of companies.
So the third which comes to mind, of course, the big engine for India is the automobiles. And automobile companies also, like banks, I would say they are having a fabulous moment in history. We are seeing superb volume growth coming through from them. And this entire trend towards premiumization means that their average selling prices are also going up. They were also impacted by higher raw material prices, but now that's flattened out.
I think the semiconductor shortage also.
That's also over and done with, right? You don't see that in the papers at all.
Interestingly, I saw that Berkshire Hathaway has substantially trimmed their stake in TSMC.
Is it so?
Yeah. Okay. So I think
then they don't see good prospects for semiconductor, which is good news for
which is good news for everyone. It's good news for capital goods. It's good news for electrical goods. Good news for automobiles. Absolutely. That whole that supply chain crunch seems to have sort of worked itself out.
That's true. So autos are doing exceedingly well. New model launches are driving growth over there. Margins also pretty much maintained.
Commercial vehicles also, I think I've seen a
Yes.
pickup in
Again,
sales.
economy picking up so automatically.
Yeah.
And these are and the auto industry has been in the doldrums for almost 6-7 years for some reason or the other. So pent up demand, overall upcycle in the industry. I think all of those factors are coming into play.
Yeah.
So very positive over there.
I think there's a really nice interplay here between banks, automobiles, and capital goods,
Yes.
right? You're seeing capital goods pick up, private capex is picking up, so consumer vehicles, commercial
Absolutely.
vehicles sales are
Absolutely.
picking up. Vehicle sales pick up, so there's more financing needs. So, bank loan books grow. It's a nice.
And then there's real estate, which is another great growth engine for the economy and a big sector for the banks to lend. And mind you, I think almost every single real estate company is setting up new projects at a frenetic pace.
I think we spoke about Godrej properties as
Yes,
well
yes,
earlier,
yes.
which is at I think record sales, record bookings.
Yeah, absolutely. I think another great company, but even the other larger companies, Shobha, DLF, Macrotech, they're all coming with exceptionally good numbers. Prices have been moving up in the last 3-4 years or so. And these companies are extremely focused on execution and delivery. So it's slick marketing, deliver the project in time, in the price, and just get the cash flows going. That's the mantra. And I love that mantra for the real estate industry. I think they're doing a great job in terms of managing the balance sheet. In the past, every time the biggest problem with real estate companies was they would take on too much of land bank and take too much of debt, and then they would not be able to service that debt, and these companies then went into big trouble. So I think real estate also very good set of numbers and did very well. I think that all the companies, all the sectors you're talking about are all done very well. But one thing where there is stress and a large sector, Varun, is software.
Software, okay, that's the export stress that you're talking
Exactly, exactly. So you alluded that there are going to be recessionary trends, and that's certainly going to affect spending on IT. And therefore, I think software companies is one area where we saw mild disappointments. Now, the interesting thing is that we went into this earnings season with very low expectations for the software companies. They came up just about at par with what the street was expecting, slightly better. Some of the companies like Infosys, they even upped the guidance, which was very well received. So I think the biggest, I would say, contribution of these software companies is the way their CFOs have managed the investor expectation. So sometimes even a bad result doesn't look so bad if you've managed the expectation well.
But I mean, I guess software is something that I'd like to dig into a little bit further, because is this a transient phenomenon, or do you think this slowdown in
You tell
growth
me,
is
should I be asking you? You are the economy expert. I think your US economy has a soft landing and then starts to pick up, and the same is true for Europe. And I think the software companies are in good shape, no?
Yeah, well, I won't disagree. Obviously, if their customers are growing, obviously their order books are going to grow. But one trend, I don't know if this has already come to pass or was still expecting this to happen. As I think the West economies, Europe, UK, US slowed down, they're going to have cost pressures. And one of the biggest spends globally for corporates is IT. One of the biggest ways to cut that spends is to offshore it to India. Now, whether they offshore it by using their own units
Captives,
in
yeah.
India, or whether they offshore it to IT service companies, that I think is yet to be seen. But surely that that phenomena of offshoring once again might, I guess, boost growth or protect
It's true.
them.
It's true. I mean, there is some element of truth in it. But then when I look at the numbers, I look at the management commentary, clearly sales cycles are lengthening. And it is thus definitely getting challenging. Furloughs have been higher this quarter. So while it is true and some benefit will be there, but it's not that you can say that software companies, for them business is as usual. No, it is not. But
But on the flip side, right? The other thing that was holding them back was consistently higher salaries for employees. Now, with a softening in demand globally,
that's right. some amount of cost pressure will come down.
Yeah.
But one thing interesting in software, Varun, is that there are certain sectors within the software space, certain verticals, where IT spending is just not slowing down, where massive disruption is taking place. Media, gaming, automobiles because of EVs and autonomous driving. And there are certain pockets like this, tech spending, where the companies over there have to spend for survival, otherwise they'll just be finished.
Yeah.
And Indian companies focused on those verticals have done very, very, very well. And I want to name a few: Tata Elixir, KPIT Cummins, Persistent Systems. I think these companies follow exceptionally good strategy, focused on the right verticals, and they have delivered a very good set of numbers because the spending by their customers has increased. It's not gone down, in fact. And then there are companies like Coforge and Infosys which come to mind, which have been very aggressive when it comes to marketing. So when it comes to software now, do not paint all these companies with the same brush. Nuances are coming out, differences are coming out, and the boys are being separated from the men. So we need to be extremely selective.
Goes back to, this is a stock pickers market.
Exactly.
If you know what to buy, then there's definitely growth to be had.
I think we are giving a lot of names over here, Arun.
Yeah. Okay. Well, let's go to maybe a down sector. Metals.
Yes.
Metals don't seem to have done very well, and I think that's just a cyclical phenomena.
Absolutely. I think it's cyclical, and I've never been a great fan of such commodity companies. If you are an industry insider and you know precisely the point of time when the industry is going to turn, prices are going to go up, volumes are going to go up, then maybe you have an edge in terms of investing in these commodity companies. But otherwise, as ordinary investors, man on the street, we don't have an edge when it comes to investing.
Plus, I think because they're such capital-intensive industries, I think it's very unlikely that they deploy new capital at a time when interest rates are so high.
That's true. I think banks, financial institutions will be a bit cagey to lend at this point of time.
Yeah.
And that certainly, I think, is going to be more and more pronounced in an industry like cement. We can talk about cement for a minute or two, where Adani Group has acquired ACC and Ambuja, and they have said they want to double the capacity. Now, because they have come in so aggressively to increase their capacity, every cement company also wants to increase their capacity by 50 to 70, 100% just to maintain their market share. So what we have is each company massively expanding capacity. And when you expand such a large capacity in such a short period of time, there could be a glut.
I think there's going to be a glut there.
And it's visible. They are not able to pass on the cost increases. Like, for example, you said that energy costs have gone up. And that's a big component for cement companies.
Yeah.
But they haven't been able to pass on the cost increases last 2-3 quarters or so. So entire commodity space, whether it's metals, cement, aluminium, I think across the board, I'd be extremely cautious.
I guess to maybe counter that, right? Okay, metals maybe not great, cement maybe not great, but how have our oil marketing companies and petrochemical companies, exploration companies, how is that sector done? Because, we've had this whole roller coaster ride of energy prices.
Yeah.
And, after everything's said and done, over the next 3 to 5 years at least, you'd expect for energy prices to stay quite high. So, and I think a couple of companies have produced some really great results as well. So, any interest in that space?
Yeah, I think Reliance came with a good set of numbers, especially their oil to chemicals division. They had decent refining margins and good cracker margins as well. And I think we are seeing the first signs of even the oil marketing companies. I think from next quarter on, they should report good numbers because they thrive when oil prices are low because they don't have to bear the subsidy. But I think there's just too much of volatility in the earnings of these companies. So I would prefer to go for some of the more steady performers. I think investors have made a lot of value, earned a lot of high returns in the consumer-oriented sectors. And India is consumer is India.
Before we move off of before we move off of, I guess, commodities, interesting piece of news to share. I don't know if you saw, but some of the largest lithium reserves in the world have been found in
Jammu and Kashmir.
Jammu and
Wow.
Kashmir.
I was just smiling
Yeah.
for a minute after I read that news. So, in my entire lifetime, I have always struggled with oil import. It's something which has really been a big bugbear for our economy in the country. And as we move towards more and more electrification, if we have the lithium,
And before these reserves were discovered, our entire EV supply chain was still at risk. It was that same
Yes.
problem where, the core material that we need as an input for our industries had to
coming
be
from
imported.
outside, yeah.
But instead, now we have, these reserves. If we exploit them properly, if we develop them properly, and they're not insignificant. They're fairly large. I think
5.7 million.
5.7 million metric tons is great. It's, that entire EV supply chain can be fully in-house then.
Maybe this is really the decade of India.
Oh, don't say things like that. Don't. This is the thing. We can't jinx it.
Absolutely.
Right.
So let's move to consumer-oriented sectors.
Consumer sectors. Then.
So when it comes to consumers, of course the big sub-segment in that is FMCG. But within FMCG, Varun, I think a lot of segments have become very mature. So therefore, across the board in FMCG, we are seeing whether it's soaps, detergents, shampoos, cosmetics, the typical household cleaning, fabric cleaning, all those categories have become very mature. The volume growth over there is low single digit to flat. And that clearly, I think, is not very positive for the FMCG companies per se. So I'd be a bit circumspect when it comes to FMCG.
That's confusing me. Why is volume growth low for, I guess, these consumer staples? Because on one hand, you expect for, as incomes continue to rise in India, you'd expect for a lot of that marginal increase in income to go into these consumer staples. And even, I think in the most recent results, the rural contribution was better, which I guess suggesting that because incomes are going up, marginal incomes are going to be, I guess, deployed in this space. Why is volume growth so low for these consumer staples?
See, first of all, I think that these companies were growing based on expansion of distribution. Now I think they have gone corner across the country. So that fillip coming from higher distribution is not coming through. Secondly, there is some linkage between consumption of consumer staples to the population growth. And India's population growth also is kind of flattening out 1 to 2% or so. And on the whole, I'm also not able to completely, put a pin as to why their growth rates have become so flat. But that's a reality.
Yeah. For example, I think I saw a statistic recently that there's only 20% of the Indian population brushes their teeth twice a day.
Yeah, but there's nothing new over there. How are you going to get them? How are you going to get the next 10%, I think? So anyway, I think that there are so many exciting trends on consumer spending beyond FMCG. I would say the new FMCG, that's where I think investors can focus on. And those are sectors like retail, hospitality, healthcare, entertainment, travel, tourism. I think quick service restaurants.
Yeah, I think hospitality had a great set of results. I think travel in general is rebounded post-pandemic.
Absolutely, I think
vengeance.
We're all traveling more, and you're going to get a seat on the airline. You don't get a hotel room. At the rack rates these days. Yeah. So boom times for travel and tourism
from Indian hotels.
Absolutely, that I would say is by far the top performer within the hospitality space. Huge incomes coming in from food, beverages, and functions, especially wedding functions.
Oh yeah! Oh
How
my
many
God,
destination
the
weddings
wedding
happening?
surge has been unreal. You open Instagram, every second post is a wedding post.
Exactly. So I think Indian hotels came with a fabulous set of numbers. They have very dynamic new CEO, and clearly he's charting the company's growth into new areas. Very positive on the company per se.
So Indian hotels, I guess I have a question on the Indian hotels because I was looking at the results a little bit deeper, and there's always this duality where the domestic holdings do quite well, their foreign holdings don't perform quite as well. At least they don't see the same, return. How big of a drag is that? Do you think that's going to change? Is that just ready?
I think it's contained. And Indian Hotels now is more India than overseas. And clearly they are looking at trying to grow through partnerships, management contracts, whereby their capital utilization is lower. But most importantly, they've got the rooms on the ground. And if you want to go to those destinations, you don't have a choice. And the biggest flip for the results coming from higher revenue per room, the rentals which they charge. So that's
And this is an entirely qualitative factor, but nothing beats Taj.
Absolutely.
Nothing beats Taj. It's just never been to a better hotel than any Taj property.
Absolutely.
I think that's
So that's what's happening. Aviation also is good, I think. Indigo came with good set of numbers, but stocks are expensive over there, and there's emerging competition coming from Air India.
Yeah, I think they placed the largest order in history.
Absolutely.
500 something Boeing and Airbus planes is a.
It's needed, I think, in this
unprecedented.
country. We're going to have more and more public traveling by air. So many new airports are also coming up. So I think it's a right move on the part of Air India. And their fleet also has been aging. So a lot of will be replacement capacity as well.
Yeah. No, interesting thing I guess to think about is that the biggest driver for revenues and valuations for airline companies is traditionally their miles programs. You buy a ticket, you earn miles. Because of competition with airfares, I don't think that airlines make as much money on pure ticket sales as they do on that miles bank, particularly with repeat customers. And Air India has, the best way to spend miles, which is Indian Hotels and Taj.
If they can have a nice program partnership in place?
Oh yeah,
I think it would be a winning combination.
For sure. I think it'll be a winning combination for Indian Hotels and Taj as well as Air India.
Absolutely. Other aspects of the consumer spending, I think, did well. Retail did also pretty decent. Companies like Trent, by and large, some of the specialty retail companies like Vedant Fashions, Campus Activewear, Metro Brands, Aditya Birla Fashion. I think broadly we had decent set of numbers. There were a few disappointments, certainly there. I thought V-Mart was a disappointing set of numbers. It's a value retailer, focuses more on the rural markets. Maybe that's where they got hit. And another company, of course, is D-Mart. I think they also came with a slightly soft set of numbers. Maybe some amount of competition coming in from the online players over there, and online delivery maybe impacting their revenues per se. But I think it was a good set of steady set of numbers for.
I have a question with retail and consumer in particular. They seem, I guess, very well positioned to capitalize on this story that we have of uneven growth and finding the right winners, because they're, at least to my understanding, low capital businesses with good operating leverage.
Yes.
So, any winners in this space or any losers in this space as well that you think should be removed from a portfolio immediately?
See, I don't want to get that granular when it comes to stocks, but I thought that the numbers which came from Titan and some of the other jewelry companies was very good. Same holds true for a company like Trent, which came with decent set of numbers. And broadly, I think these specialty retail companies like Vedant Fashion, Go Colors, Metro Brands, Campus Activewear, they were able to sustain their top line. They were able to sustain their profit margins as well. But because they're expanding their retail network at a frenetic pace, we are seeing that their depreciation and interest costs have been inching up, and so that's affected the bottom line per se. But all that spending is going to, lead to higher sales going forward. So I would say that many more winners on the retail side than losers. And connected with retail is, of course, entertainment and quick service.
Before we go to entertainment, two questions. So you mentioned that jewelry companies like Titan have done very well. Is that because of this whole wedding season bounce, and do we expect that to, I guess, dissipate as that pent-up pandemic wedding demand goes away, or do you think that's here to stay?
No, I think that some amount is coming from the wedding demand, but underlying, there's a huge trend where consumers are shifting away from the unorganized to the organized, just because of trust factor. And I think that's what's benefiting the likes of Titan and other leading jewelry chains per se.
Okay. That's interesting. And for, I guess, the other brands that you mentioned, I guess I want to contrast this with like FMCG, because you mentioned that with FMCG, they're done with that growth fillip through higher distribution.
That's right. I think that's where what's driving growth as far as a lot of retail players are concerned. They are ramping up their store network, and they're going into more and more deeper into tier 2, tier 3. And that's, I think, what's going to drive growth going forward for them.
Anyone in particular that's done really well with distribution growth?
Well, nothing specific comes to mind. And, Varun, I think we leave stock specific to our Instagram
Okay.
and our Twitter post, so that there's always that surprise factor over there.
All right.
And let's stick to larger industry trends in this podcast.
All right.
So from retail, let's go quickly to I would say entertainment, which is of course quick service restaurants, multiplexes. I think those also have done pretty well over there. You could even add a company like Phoenix, which manages malls. So I think India is having a gala time. They are going out more to restaurants, and they are spending more on entertainment as well. And these companies also, I think, sectors did pretty much well. Big development coming on the entertainment side. We have the merger of PVR and Inox, and that could be a game changer for the entire multiplex industry. So let's see how that plays out. And then related to that is healthcare.
So, before we go on to healthcare, I want to just go back to PVR and Inox very quickly. And I guess ask, because we've spoken previously, that what drives growth for these guys is oftentimes new releases by Bollywood and Tollywood. And major release of Pathan, which was
It's
extremely
done
successful,
really well. And before
right?
that, it was that English movie Avatar.
Yeah. So I guess, do you expect to continue seeing that release?
I think
Pipeline?
that Pathan is going to be a shot in the arm for the film production industry, because they might be scratching their heads why films are not being so successful at box office. But I think this is a nice winning combination for them, and I think it will drive more investment into new films. Interestingly, PVR Inox merged entity wants to look at spending more money on content and on financing new movies for multiplexes, and I think that's the right way forward for them as well.
But is that a capital efficient strategy?
So I think in a
Because
way
the
it is to
production
sustain
cycle,
growth.
because the production cycle of movies is fairly long. It's not, quick. You decide to invest in a movie, it'll take 3 years before it comes to the market. It's
But they got to start somewhere, no? Because otherwise the content will dry up for them 3 years hence. And I think clearly they are trying to counter more and more of the film production going for OTT type of content. So from their perspective, it is right. And mind you, these are large companies. They're not going to spend a very large percentage of their capital in it. But seeding interesting ideas which can play out over 2-3 year period, I think that's a fair strategy.
I think that the success of Pathan at the box office, if anything, has probably given filmmakers something to think
Absolutely.
about. Because I'll bet they made more money doing that than selling to OTT platforms. That just seems logical. And
Box office is a huge source of revenue for film producers.
okay, so blue skies ahead then for entertainment companies as well is good news for the
But
consumers.
there'll always be cycles within cycles. Investors need to keep in mind that even the sectors we spoke about, the consumer-oriented ones, the likes of retail, entertainment, quick service, even hospitality, for that matter, there are going to be cycles within cycles. It won't be a straight line.
Okay. So speaking of cycles, let's talk about pharma. It's been through a huge cycle of its own, pandemic driven, obviously. Where do we find ourselves with pharma right now?
Again, pharma is like a software. Selective. And certain pharma companies which are focused on the Indian market, they did very well. Alchem and JB Chemicals comes to mind. And then within the larger pharma companies, Sun Pharma, I think they follow a differentiated strategy where they are focusing on specialty products, and they were also able to sustain growth. So was Dr. Reddy because of one specific molecule, Revlimid, I think if I got
I
it
think
right.
Dr. Reddy had a great quarter.
That's because of one specific molecule where they had exclusivity. It's not likely to be repeated over the next quarter, March quarter. They may have a spillover effect, but not beyond that. But Varun, pharma is a very complicated sector, and there was a time when it made great value for investors because they were just launching new molecules and there was price stability, and you could clearly see earning visibility of 10, 15, 20%. But that's no longer there within the sector. So I'd be a bit cautious on pharma as a whole. And I thought even contract manufacturing companies like Divi's Laboratories and Suven Pharma, Piramal Pharma, they also disappointed. So there are too many landmines in the pharma sector. And I just like to be a bit cautious over there. So I guess that covers almost the entire spectrum
Yep.
of sectors. And as I said, I think selectivity, stock pickers,
Stockpickers paradise, right?
that's the way I think going forward as well.
I have a question, right? Of of all the sectors we've spoken about, and all the companies we've spoken about, what do you see as the most underrated sector or company to put for investors to put their money into?
Wow, that's a tough one. But underrated,
Something that's flown under the radar, something that maybe people haven't noticed.
chemicals, I think we didn't discuss that. And we're going to discuss also the new age digital companies. I don't know why we forgot them. We're just sorry, viewers, for just 5, 10 more minutes. So, chemical industry, I think they've been under a lot of pressure last 2, 3 quarters or so because of higher cost increases and supply disruptions and China factor as well. But now a lot of the expanded capacities are coming into play. They've been able to pass on cost increases as well. So a lot of the specialty chemical companies are getting their mojo back. And I think that's very positive because there's great scope for chemical companies in this China plus one strategy. And India certainly, like pharma, has an edge when it comes to chemicals. So I think a lot of chemical companies, Aarti Industries, SRF, Vanita Organics, many such companies, Anupam Rasayan, there are at least 30, 40 such large chemical companies, some with very strong niches, global capacities, very strong competitive edge. I think broadly we are seeing a revival of the growth phase over there. That's going to, I think, gather momentum in the March quarter as well. PI Industries, agrochemical company, came with a spectacular set of numbers. And then last, of course, let's talk about PayTM and Zomatos.
The digital companies.
Yeah. So, Varun, I haven't seen, we live in interesting times. These managements are actually listening to their investors. PayTM, Nykaa, Zomato, PB FinTech, you name it, they're listening to their investors. And their investors are telling them that enough is enough. Please show us the road to profitability. When are you going to break even?
Yeah, I think PayTM broke even ahead of schedule as well.
Exactly. And Zomato also in the pure food delivery business seems to have broken even. Of course, they keep on having these adjusted revenues and adjusted profits and adjusted earnings. But nonetheless, they are on the path to profitability, which is really very positive from that perspective. And mind you, these stocks haven't corrected in this earnings season. They haven't gone down.
Yeah.
So that's a very positive sign. And also what is happening is that we are understanding them better.
Mm-hmm.
These are not typical businesses like cement and like capital goods banks, which are easy to understand. These are complex businesses to understand as well. Like how PayTM earns its money by itself, you need to dig very deep into their earnings releases and understand. And same is true for Zomato and Nykaa and PB FinTech as well. So there is a lot of understanding which was missing earlier when they got listed. But now I think investors are finally grappling with what this animal is all about. And my sense is that now at least they should start giving decent returns, not maybe multi-baggers, which I thought they will too, and they may be so 5, 10 years into the future. But next 2, 3 years, I think we see them providing decent returns. and we'll see them reporting good earnings. And at some point of time, I think an inflection point will come where investors will start, again appreciating their business model, rather reappreciating, and value them higher and higher based on price to earnings or price to book or whichever the multiple.
Okay. So it seems like having covered off all the major
Yes.
sectors, I guess, at least of the market.
We've provided the foundation for an investor to plan his next few months investment strategy, which
Certainly.
sectors they should look at positively and which other sectors to avoid.
It seems like it's blue skies ahead, and Stockpickers paradise, right? That
Yes,
seems to be the key takeaway.
absolutely. And maybe next podcast, what we may discuss in this, let's take the stock pickers theme forward, and let's talk about what investors should look for in companies. What is the common thread?
Okay.
And if you're going to look at picking stocks, then what should you be looking at into stock when you want to pick them?
Okay. Well, I think that gives people a reason to tune in next time.
All right.
And yeah, I think that's all we have for today.
Great talking to you, Varun. Look forward to the next one.
All right. Fantastic.